Okay, here's an example of what we mean by opportunity costs. We've got two businesses that are basically grossing the same amount, $150,000 worth of gross income. And in business A, we have a few things going on there that are different than in business B. We typically, in this case, the example is that both have rent of $10,000. And in business A, there are no manager's wages, whereas in business B, you have to hire a manager and pay them $25,000. So there's a major difference there, even though they're very similar businesses. And then we have cost of goods for resale of $50,000. Okay, same for both A and B. And then our hired labor is the same. And we get a total of expenditures of $90,000 for business A because of the fact that we didn't pay any wages for a manager compared to business B where we had to. And this could be it's a very simplified type of an example, but on the same token, what we're talking about here is something that happens in small business all the time. I mean, all of us. Bev and I both have been in businesses. I'll bet she's been in that boat where we decided not to pay ourselves even though we were actually working in the business, probably worth more than $25,000. We just didn't have the funding in order to make the wages, or we were putting all of our extra cash back into the business in order to enable it to grow. So we end up with a total expenditures that look differently. So for an accounting profit with this type of a very simplified approach to this, in example A, we actually have $60,000 that would be considered accounting profit, whereas in business B, where we have total expenditures of $115,000, we would have $35,000. Okay, but with the calculation with opportunity costs, let me move that up there, included in the expenditure side of things, we actually have an opportunity cost that in order to compare these two of $25,000 that we would assume in the business A model. And so the economic profit here actually becomes $35,000 here. And it's already included here in this example. So we have two businesses that now with opportunity costs we can compare with all their production expenditures actually being equalized. So that's just an example of an opportunity cost that we might, and how we might calculate. Okay, hopefully that helps. Some important things to remember as far as opportunity costs are the economic profits include the value of all the factors or inputs of production regardless of whether they're actually paid or not. So that's just an easier, more simplified way of saying that we would include those things whether or not they're an actual expenditure when we include our opportunity costs. And the economic profits of the two businesses would be similar, even though their accounting profits are completely different and diverge from each other in actuality. And from here on out, what I want to emphasize in this whole process is that when we say profit in an economic sense, we're always talking about economic profit, those with the opportunity costs included. Okay, so to properly consider all the opportunities, the opportunity costs, one must actually consider things like renting land and other resources, investing monetary resources elsewhere. Okay, instead of investing capital in your business, in a business, then we could actually do a real quick down and dirty opportunity cost study, if we were to put that into what we could get in a regular CD or money market account, which is not much right now, right? In ag, we talk about a return on total capital of 1.5 to 2% at best. So we actually could compare those fairly easily by using those instruments to compare it with. Right now, we're certainly not experiencing 8 to 10% return on investment if we were to put it in the stock market, but it had been that way for the last 11 years. So in the not so distant past, we might have used that as the comparison. What would be the comparison and opportunity cost that we lost out on with the use of our capital in the stock market as compared to putting it into our businesses? So, and also, if we were to do nothing at all, what would that mean for our resources? And we would maybe look at things a little bit different. Just some really great exercises that are very academic in our thinking. It might change your thinking as you get into business, if that's the way you're thinking about. If nothing else, if you go to work for somebody, you might know a little bit more about what's going on at the upper end of the management scale and why they're making some of the decisions that they do. So I know for a fact that employees have a tendency to question that, and those are great questions. And it helps you be a better employee if you're in that area at any given point, and especially if you aspire to be a business leader and own your own business, or manage your own business if that kind of opportunities come along. So you can look at opportunity cost in another way too. What if you were given $1,000? And earlier in the week, I sent you an email of a video that I had been asked. What are you going to do with your $1,200 that the government's going to just wire into your account? Assuming they have your bank account information, and if you're like 88% of those that filed returns last year, they have that information. That's how they intend to actually push that money out into the economy, is directly into your bank account. And what would you do with it? So we have a real-time study on all this kind of stuff. What if I were to give you $1,000, what would you do with it? Would you go out and buy groceries? Would you go out and use it on fast food? Would you use it for recreation? Would you use it for vacation? Or would you invest it? Is there a higher return in investing it compared to going on a holiday trip? What would you do with it? Would you try to make money with it? Would you invest it? Would you let it sit in an account and I just had actually a high interest savings account inform me the other day they were down to 1.45% up until recently, but as of last week, it has, because of the prime rate that the Fed had changed, and it's basically zero at the federal level. The rate that the Fed charges banks, money is free to them right now at a 0% interest rate. Figure that. I had a few people tell me that it was headed to zero 6 to 8 months ago, and I almost didn't believe it at that point, but they've been proven right. Would you let it sit in an account? If you let it sit in an account, do you have to factor in inflation that we might have because of all this money hitting the economy at once? Those are things that may not unravel for a while, but those are things that in business you're going to have to take into account. So what is production? Okay, I mean, at the lowest level, at the most simplistic level, all we're doing in production is we're taking inputs and we're converting them to an output that can be purchased, a good or service, out onto the market. So that's what we're talking about, the most simple fashion of production. And even if you have a storefront and you're selling things, you're actually bundling resources. And you might say, well, I just bought a piano and I'm just putting it out on the floor and I'm going to sell it to somebody. I'm going to mark it up and sell it. But it takes resources. It took the rent, it took the electric bill, it took the labor. Maybe you've got some employees that you need to hire in order to make that transaction happen. All those things are bundled up into that output. So what we've done is we're just converting inputs to outputs is what actual production is. And if you look at other economic papers and research and that sort of thing, inputs is what I'll be referring to them in this class, but they're also, if you run across these terms, which are very used interchangeably, they are the factors of production or resources of production as well. So all those are synonymous to the same thing. They're just the inputs. It just is what do you have to bundle in order to have an output to offer as a good or service on the very far end of the production scale. So for some examples, products and services in the ag world, we talk about hay, fat cattle that have been finished. There's been stages of production that we talk about within that, so we can actually partition some of that production out, and as it moves along in the production fashion, and it gets closer and closer as a good or service that can be offered to the consumer. Cotton, flats of strawberries, all that kind of stuff. It takes a certain amount of inputs in order to provide a haircut for the ultimate consumer. A meal at a restaurant, many resources go into that, and you can give your own examples for all those things that the owner and the manager are responsible for putting together, bundling together for those kinds of things. So anything that's offered as a good or service in our economy actually includes all those things, those inputs that are available. Okay, so I'm going to pause. This will be the end of production video number 2. And I'll let you take a little break if you're taking notes. Hopefully you are. And we'll start her up again here in a little bit.